Long-term bond yields have risen about 1.5% over the past 6 months, including an acceleration in recent weeks, yet not because of the obvious reasons. Fed rate futures have barely budged, even with the Fed's recent hawkish commentary and taking out 2 interest rate cuts from their projections for next year, and inflation expectations have stabilized. Without those common explanations for the movement in yields, we're left with 2 somewhat less satisfying and more complicated explanations: the term premium and market technicals. Let's take a closer look. The term premium is the compensation investors demand for taking interest rate risk on longer-term bonds such as the 10-year Treasury. We think investors are demanding more yield because of uncertain outlooks on a number of fronts, including the path of the economy, inflation, the long-term financial health of the U.S. government, and the associated political dysfunction in Washington. These issues have pushed term premiums above the very low levels the market saw for years as the Fed maintained easy monetary policy after the global financial crisis in 2008. Further lifting yields are market technicals, as supply outstrips demand. The U.S. government is issuing an elevated supply of treasuries, but the Fed and some buyers outside the U.S. have pulled back on their purchases. When long-term yields initially began their ascent, equities still rose as we believe investors stayed confident that slowing economic growth would taper into a soft landing. But as yields have continued upward, investors have become increasingly worried that higher interest rates may cause the economy to stumble. As a result, equities have fallen and the bond market has faltered with higher credit spreads. Our view has been that economic growth will disappoint because consumers are spending down their savings, and the consequences of the Fed's rate hike campaign on the economy has yet to be fully felt. Further complicating the economic outlook, high long-term yields also may hurt economic sectors most sensitive to interest rates and discourage new business investments. We think yields have overshot a bit over the intermediate term, but markets and the economy are still adapting to the end of the easy money era post the global financial crisis. If higher rates feed fears of recession, we could see an arrest of the upward climb in long-term yields. In the event of a broadening of the conflict in the Middle East following the human tragedy that unfolded over the weekend in Israel, investors could also push yields lower as they seek safety in treasuries. Even if yields do fall, we believe risks to global growth remain, limiting the upside to stocks.